Something unusual happened in Washington that most people still haven't fully processed. It wasn't loud. There was no dramatic market crash at the exact moment it happened. No red banners flashing across every television network. But for people who watch commodities, defense policy, and industrial supply chains closely, the tone of the conversation shifted in a way that rarely happens in a single afternoon. The vice president stood at a podium during a strategic minerals conference attended by diplomats, trade officials, and industry representatives from dozens of countries. The room itself wasn't particularly dramatic. Just another government hall, rows of suits, quiet translation headsets, cameras set up along the back wall. But the words that followed carried weight far beyond that room. He spoke about supply chains, about industrial security, about the risks of relying on unstable markets for materials that modern infrastructure depends on. Then he said something that made analysts lean forward in their seats. He talked about defending minimum price levels for certain critical minerals, not stabilizing, not monitoring, defending. And among the metals being discussed was silver. At first, the statement sounded technical, almost bureaucratic. Trade mechanisms, tariff structures, coordinated purchasing agreements, phrases that usually put people to sleep. But anyone who understands how commodity markets work knows that a government stepping into price defense is not a minor administrative detail. It changes incentives, it changes risk calculations, and sometimes it changes the entire trajectory of a market. Because a price floor does one thing above all else. It changes the psychology of both buyers and sellers. Think about how most investors view commodities. Prices rise and fall based on supply and demand, speculation, currency movements, and geopolitical tensions. That unpredictability is part of the game. Traders accept volatility because volatility is where profits come from. But the moment a government signals that it may not allow prices to fall below certain levels, the equation changes. Suddenly, downside risk begins to look different. Not eliminated, but buffered. And when downside risk shifts, behavior shifts with it. That is what made the announcement significant. Not just the policy itself, but what it suggested about how seriously governments are beginning to treat industrial metals. Silver, in particular, occupies a strange position in the global economy. To most people, it is still seen as a precious metal, something stored in coins, bars, or jewelry. But in reality, silver is also an industrial material woven deeply into modern technology. Solar panels rely on it for conductivity. Electric vehicles use it in power systems and electronics. Data centers consume it in components most people never see. Medical equipment, aerospace systems, communications hardware, the list keeps expanding. And unlike many materials, silver is often used in ways that make recycling difficult or uneconomical. Once it's embedded into thousands of microscopic connections or industrial components, it rarely returns to the market in meaningful quantities. That means consumption quietly chips away at available supply year after year. At the same time, mining silver is more complicated than most people realize. A large portion of global silver production doesn't come from mines dedicated solely to silver. It comes as a byproduct of mining for other metals like copper, lead, and zinc. That means even if silver prices rise, production cannot always increase quickly, because miners are responding primarily to the economics of other metals. So the supply side moves slowly, the demand side moves quickly, and governments are beginning to notice the imbalance. In recent years, policymakers have started using a phrase that used to be reserved for oil and rare earth elements: strategic vulnerability. That phrase means a country's economy or defense systems depend on materials that could become scarce or politically restricted. When officials start using those words, it usually signals that policy changes are coming. And that is exactly what appears to be happening now. The proposal discussed at the conference outlined mechanisms that could involve coordinated tariffs, purchasing agreements among allied countries, and incentives designed to keep domestic production viable even when global prices fluctuate. In plain terms, the goal is to prevent scenarios where low-cost dumping by foreign producers collapses prices, forces mines to shut down, and then leaves supply chains exposed when demand surges again. This is not a theoretical concern. It has happened before in multiple industries, from steel to semiconductors, where aggressive pricing temporarily reshaped markets and later created shortages. Officials speaking at the event emphasized resilience repeatedly. Not profit, not speculation, resilience. That word matters, because resilience means governments are thinking in decades, not trading sessions. And when governments begin planning in decades, markets eventually follow. Another point that drew attention was the discussion of cooperative frameworks among allied nations. Instead of acting alone, the proposal hinted at forming coordinated purchasing and trade agreements that would create a stable demand base for producers inside the network. That kind of structure does more than support prices. It reshapes global trade flows. Producers gravitate towards stable buyers. Investors fund projects with predictable revenue streams. Infrastructure builds around reliable supply chains. Slowly, almost quietly, the center of gravity shifts. Meanwhile, the broader silver market has already been experiencing volatility that reflects deeper tension beneath the surface. Large price swings over the past year have shown just how sensitive the metal has become to changes in industrial demand, currency movements, and investor sentiment. Those swings aren't random. They're symptoms of a market trying to find equilibrium while structural forces pull it in different directions. On one side, industrial demand continues to grow, driven by electrification, renewable energy, and digital infrastructure. On the other side, financial markets still treat silver partly as a speculative asset, reacting quickly to interest rates and macroeconomic signals. Add geopolitical competition to that mix, and you begin to see why governments are paying attention. Because when a material sits at the intersection of industry, technology, and national security, its price stops being just a market signal. It becomes a strategic variable. And that is the real significance of what was said at that podium. Not a single policy detail, not a headline number, but the shift in how silver is being discussed at the highest levels. For decades, conversations about silver were dominated by traders, miners, and analysts. Now, defense planners, trade negotiators, and technology firms are part of the same conversation. When that happens, markets rarely remain the same. Most people haven't noticed yet. Financial headlines move fast, and attention shifts quickly. But sometimes the most important changes don't arrive with fireworks. They arrive with technical language, cautious phrasing, and policy discussions that sound dry, until you realize what they imply. And what they imply now is simple. Silver is no longer being treated as just another commodity. It is being treated as infrastructure. And once a resource is classified that way, the rules governing it begin to change. The real question is not whether those changes will affect the market. The real question is how far those changes will go. To understand why governments are starting to talk about silver differently, you have to look beyond headlines and into the structure of the market itself. Because what's happening is not just about one announcement or one policy discussion. It's about pressures that have been building quietly for years, largely unnoticed outside of specialized circles. One of those pressures is the widening gap between how much silver the world uses and how much it produces. On paper, global supply and demand figures often look balanced within a narrow range. But those numbers don't always capture the full picture. They measure what can be tracked through official channels: mine production, recycling, and recorded industrial demand. What they don't fully capture are the secondary layers of consumption that have been growing steadily as technology advances. Every new generation of electronics tends to use more complex circuitry. Every expansion of data infrastructure increases the demand for high-conductivity materials. Solar capacity continues to scale at a pace that would have seemed unrealistic a decade ago. And military and aerospace systems incorporate materials in ways that are rarely disclosed publicly. Individually, these uses seem small. Collectively, they add up to a steady drain. At the same time, new mining projects have become harder to develop. Environmental permitting takes longer. Financing requires stronger guarantees. Infrastructure costs have risen. And in many regions, the richest deposits were discovered decades ago. meaning newer projects often involve lower ore grades and higher operating costs. That combination, rising consumption and constrained production, creates a structural tension that doesn't always show up immediately in price. Markets can mask shortages for years through inventories, recycling, and financial derivatives. But eventually, physical reality begins to assert itself. And when it does, the adjustment can be sudden. Another factor that has been quietly reshaping the silver market is the way it is traded financially. Unlike most industrial metals, silver exists simultaneously in two worlds. There is the physical market, bars, coins, industrial supply. And then there is the paper market, where contracts representing far larger quantities change hands daily. That financial layer provides liquidity and price discovery, but it also introduces leverage. Large positions can influence short-term movements. Sentiment can drive swings that have little to do with immediate supply and demand. And in periods of stress, the relationship between physical metal and financial contracts can become strained. This is not unique to silver, but the effect can be more pronounced because of the metal's dual identity as both a monetary and industrial asset. When investors seek safe havens, silver attracts attention alongside gold. When manufacturing expands, it draws demand as an industrial input. Few commodities respond to such a wide range of forces simultaneously. That complexity is part of what makes the current moment so interesting. Because now a third layer is being added to the equation: strategic policy. Governments rarely intervene directly in commodity markets unless they believe something critical is at stake. Oil reserves, grain stockpiles, rare earth supply chains. History shows that intervention usually follows periods of vulnerability. And vulnerability is precisely what many analysts believe is emerging in metals tied to electrification and digital infrastructure. Consider how rapidly global electricity demand is rising. Data centers alone are projected to consume dramatically more power over the next decade as artificial intelligence systems expand. Renewable energy installations continue to accelerate. Electric vehicles are becoming a larger share of transportation. All of these systems rely on materials with high electrical conductivity, corrosion resistance, and reliability under extreme conditions. Silver happens to possess all three characteristics in exceptional measure. That doesn't mean substitutes don't exist, but substitutes often reduce efficiency, increase heat, or shorten equipment lifespan. In high-performance applications, those trade-offs matter. So demand continues to grow, often invisibly, embedded inside technologies most people never think about. Meanwhile, geopolitical tensions are reshaping how countries think about supply chains. Over the past several years, governments have learned difficult lessons about dependency, whether it was energy supplies, semiconductor manufacturing, or medical equipment. The realization that critical inputs could become unavailable overnight has altered planning across multiple industries. Strategic stockpiles, once considered relics of the Cold War, are returning as policy tools. Governments are once again evaluating which materials they cannot afford to run short of. And when a material appears on those lists, markets tend to react, not always immediately, but inevitably. Another element adding pressure to the system is the concentration of refining and processing capacity in certain regions of the world. Even when raw materials are mined in multiple countries, the ability to refine them into usable forms can be geographically concentrated. That creates choke points that become visible only during periods of disruption. Trade restrictions, export controls, or logistical bottlenecks can ripple outward, affecting prices far from their origin. In recent years, several countries have begun tightening control over strategic resources, sometimes gradually, sometimes abruptly. Each restriction sends a signal to markets that supply chains are not as secure as they once seemed. And signals accumulate. Investors begin to notice patterns. Manufacturers begin to secure long-term contracts. Governments begin to explore cooperative agreements. Slowly, the market shifts from complacency to caution. One of the most interesting aspects of this transition is how quietly it often unfolds. Major changes in commodity markets rarely begin with dramatic headlines. They begin with small adjustments, new procurement policies, pilot programs, changes in classification, revised trade rules. Each step seems minor on its own. Together, they form a trend. And trends, once established, can accelerate faster than expected. The volatility seen in silver prices over the past year may be an early reflection of that acceleration. Rapid increases, followed by sharp corrections, often indicate that markets are struggling to reconcile old assumptions with new realities. Some participants still view silver primarily as a speculative asset. Others increasingly see it as a strategic industrial resource. When those perspectives collide, prices can move violently. But beneath the volatility, the underlying drivers continue to evolve. Industrial demand does not disappear because traders sell futures contracts. Infrastructure projects do not pause because markets experience corrections. And policy decisions, once implemented, tend to persist longer than market cycles. That is why analysts who focus on long-term trends are paying close attention to developments that might seem technical or bureaucratic to the average observer. Because technical details often shape the future more than dramatic headlines. And right now, the technical details, supply deficits, strategic designations, coordinated trade discussions, and growing industrial consumption are all pointing in the same direction. A direction that suggests silver is entering a new phase of its history. Not overnight, not in a straight line, but steadily, as structural forces reshape the market from the inside. The question is not whether change is coming. The question is how quickly the rest of the world will recognize it. History offers several examples. Oil in the mid-20th century moved from being just another industrial input to becoming the center of global strategic planning. Rare earth elements, once obscure, became critical once electronics and renewable technologies expanded. Even lithium, which received little attention outside of specialized industries 2 decades ago, is now discussed regularly in policy debates and international trade negotiations. In each of those cases, the transition followed a similar pattern. First came rising demand driven by new technologies. Then came supply constraints, often due to geology, infrastructure, or geopolitics. Finally, governments stepped in, not necessarily to control markets, but to secure access and stabilize supply. Silver appears to be moving along that same path. What makes the current moment particularly significant is the convergence of several powerful forces at once. Electrification of transportation, expansion of renewable energy, rapid growth in data infrastructure, and increasing geopolitical competition are all happening simultaneously. Each of those trends increases demand for materials that conduct electricity efficiently and reliably. Unlike some other metals, silver's unique properties are difficult to replicate fully. Alternatives exist, but they often come with compromises that matter in high-performance systems. That means demand tends to persist even when prices rise, especially in applications where reliability is critical. At the same time, supply is constrained not only by mining capacity, but by the time required to develop new projects. From discovery to production, a major mining operation can take a decade or more. Environmental assessments, financing, infrastructure, and permitting all add layers of complexity that cannot be rushed easily. That lag creates a dynamic where demand can increase faster than supply can respond. When that happens, markets become sensitive. Prices react more sharply to disruptions. Inventories become more valuable, and long-term contracts become more important than spot purchases. Governments understand this dynamic well, which is why strategic reserves and cooperative trade agreements are returning to policy discussions. These tools are designed not to eliminate market forces, but to reduce vulnerability to sudden shortages. For investors and observers, this raises an important question. What happens when a commodity transitions from being purely cyclical to being strategically managed? The answer is not simple, because such transitions rarely follow a straight line. Prices can still fall during recessions. Speculative bubbles can still form and burst. Short-term volatility does not disappear. What changes is the long-term floor beneath the market. When governments and major industries consider a resource essential, they tend to act when prices fall too low, either through purchasing, incentives, or trade measures designed to protect production capacity. That doesn't guarantee constant price increases, but it alters the risk profile over time. Another factor likely to shape the future of silver is the evolution of global trade alliances. As supply chains become more regionalized, countries are forming partnerships to secure access to key materials. These alliances are not always formal treaties. Sometimes they take the form of coordinated investment, shared infrastructure, or long-term procurement agreements. Such arrangements can gradually redirect trade flows, concentrating supply within networks of countries that trust one another economically and politically. If that trend continues, it could change how silver moves around the world. Who buys it, who refines it, and who controls the logistics of delivering it to manufacturers. That shift may not make daily headlines, but over time it can reshape entire markets. At the same time, technological innovation continues to increase the importance of reliable electrical systems. Artificial intelligence, cloud computing, and advanced manufacturing all depend on hardware that must operate continuously under demanding conditions. Small improvements in conductivity or durability can translate into significant performance gains at scale. That is one reason technology companies have begun paying closer attention to raw materials. Their products may be digital, but the infrastructure that supports them is deeply physical. Every server, every network switch, every high-performance processor ultimately depends on materials that must be mined, refined, and transported. And those supply chains are only as strong as their weakest link. One of the most unpredictable elements in the silver market is how quickly sentiment can shift. Financial markets are forward-looking by nature. Once investors become convinced that structural demand is rising faster than supply, capital tends to move quickly. That doesn't always mean prices rise smoothly. Often, markets overshoot, correct sharply, and then resume their trend. Volatility becomes part of the landscape rather than a temporary disturbance. For viewers and readers trying to make sense of these movements, the challenge is separating short-term noise from long-term signals. Daily price changes, speculative trades, and headlines about market swings can obscure the deeper forces at work. But the deeper forces, industrial demand, supply constraints, and strategic policy, move more slowly and often more predictably. Those are the forces that shape decades, not days. Another aspect worth considering is how public awareness evolves. Many major economic shifts begin outside the spotlight, discussed primarily among specialists. Only later do they become widely recognized, at which point the narrative changes from curiosity to inevitability. Silver may still be in that early phase, where the conversation is growing, but not yet dominant in mainstream discourse. If that changes, the psychological impact on markets could be significant. Commodities are influenced not only by physical supply and demand, but by perception. When enough participants begin to believe that a resource is becoming scarce or strategically important, behavior changes, sometimes rapidly. Manufacturers secure contracts earlier. Investors allocate capital differently. Governments accelerate planning. Momentum builds. But it is also important to remain grounded. Markets rarely move in a straight line toward extreme predictions. Long-term trends can take years to unfold, and unexpected developments, technological breakthroughs, economic slowdowns, or policy reversals can alter trajectories. The future of silver will likely be shaped by a combination of factors rather than a single dramatic event. What seems clear, however, is that the metal is no longer being viewed in the same way it was a decade ago. The conversation has broadened. The stakes have increased. and the number of institutions paying close attention has grown. That alone is significant, because when governments, industries, and financial markets all begin focusing on the same resource, it usually means the world is changing in ways that are not immediately visible, but eventually become impossible to ignore. And the next few years may be the period when those changes move from quiet discussions to undeniable reality.